This chart tracks consumer sentiment. Recently, the University of Michigan recorded a score of 49.8, the lowest level since 1978. This is a steeper drop than the 2008 financial crisis and the darkest months of the 2020 lockdowns. Yet actual retail spending is moving in the opposite direction. Daily consumer budgets remain resilient. While sentiment surveys suggest the economy is failing, the cash registers tell a different story. This gap exists because our primary indicators are retrospective. The University of Michigan captures how people felt yesterday, while the Federal Reserve measures what they spent last month. These surveys also fail to account for the mechanism of the transaction. They see the purchase, but they do not see how it was financed. This resilience is a mirage. Underneath the surface of stable spending, a structural debt contagion is spreading, invisible to traditional risk models. Current spending is being propped up by phantom liquidity. This is toxic, short-term leverage used to maintain basic consumption when cash flow dries up. Families are using survival tactics that bypass traditional oversight. They're using unregulated buy now, pay later apps for groceries and rotating credit card balances to cover 30% spikes in auto insurance. These pre-delinquency stresses are trapped in an 18 to 24-month blind spot. Because this shadow debt isn't always reported to credit bureaus, it remains hidden from the very institutions that monitor economic health. This leverage eventually metastasizes into formal non-performing loans and utility bad debt write-offs. Only then does the crisis finally appear in central banking data. By the time the Federal Reserve reacts to lagging indicators, the default wave will have already reached a scale that wipes out corporate defensive capital. Inflation is the systemic sum of millions of isolated, rational decisions. These decisions feed an engine of localized chaos called the sub-optimization trap. A utility raises rates to cover bad debt losses, forcing a local transit authority to cut routes. A worker loses hours, maxes out a credit card to pay the utility, and defaults. The local bank tightens credit, forcing the utility to raise rates even higher. Every entity acted rationally on its own ledger. Together, they created the exact structural inflation that central banks are currently struggling to curb. We can solve this by treating the individual household as a high-frequency macro sensor, providing ground truth data in real time. The sovereignty engine uses attestation questions to capture these stress points. Households can cryptographically verify survival gaps, like missed utility payments, without actually sharing their raw personal data. As multiple households in the same geographic zone attest to the same pressure, the data aggregates. The protocol monitors this consensus. When density reaches 30, 50, or 61%, it signals a localized crisis long before impacting national indices. This predictive reservoir allows institutions to see accumulating risk 6 to 12 months before it appears on a bank's ledger. The Federal Reserve uses blunt tools like interest rate adjustments to influence the entire country. Geohash data allows for a precision scalpel, targeted capital intervention in specific neighborhoods. Milton Friedman famously observed that monetary policy operates with long and variable lags, making it difficult to time correctly. To eliminate that lag, the system uses an architectural trigger. When a geohash hits a 67% consensus, it activates fractional syndication. This mechanism coordinates capital to intervene the moment the distress is verified, deflating localized credit bubbles before they can burst. Capital then moves through 3 synchronized flows. The first flow goes directly to the household. Microcredits clear survival gaps like utility arrears, breaking the shadow debt cycle and keeping the sensor online. The second flow supports civic entities. It funds local transit, childcare, and energy assistance, lowering the structural cost of living without triggering the inflation associated with printing new money. Finally, capital flows to corporate balance sheets as a geohash dividend. When utilities and banks preemptively stop bad debt and attrition, they recompose capital that was previously being lost to waste. This recovered efficiency results in a verified 36-to-1 return on investment for the participating entities. Because this coordination layer closes the financial gaps that fueled a spiral, the expected inflation never actually materializes. Households are making impossible choices right now. These are fractures in our economic foundation, currently hidden in an 18-month blind spot. Enterprise leaders can continue waiting 18 months for an economic autopsy report, or that can choose to witness and solve these survival gaps today. True economic stability relies on enterprise risk coordination. It captures the yield of solving distress at the source before it has the chance to scale into a national crisis.